welcome to Spark Insights. My name is Katharina Pillman, and I work in the SparkLive team at the London Stock Exchange, where I advise clients on the communication of their financial results. I'm delighted to have today's session, where we will explore what defines effective investor targeting and the role of technology in that. We will also look at how IR teams can measure engagement success and what's next in this evolving space. I'm delighted that I'm joined by a panel of experts who I will hand over now to introduce themselves. It would also be great if you can add a fun fact about yourself for the audience. Mark, if you can please go ahead.
Good afternoon, everyone. I'm Mark Robinson, Head of Strategic Accounts at RDIR, which is part of Equiniti. So my role is looking after FTSE 100 and 250 companies for their share register analysis and investor targeting efforts. Been with the company for 10 years and in the industry for 20 years when I had a lot less grey hairs. Fun fact about me, trying to keep this PG. So I discovered on one trip to Mexico that sleeping in a hammock in just your swimming shorts means that you wake up with an awful lot of creepy crawlies on you, which was a rather awful awakening experience.
Thank you for that. Next, Philip, if you can introduce yourself, please.
For sure. Thank you, Katharina. So my name is Phil. I am a manager of professional services here at Irwin, a part of the broader FactSet list of companies. Fun fact about myself, I'm an aspiring home chef, primarily specializing in East Asian cuisine. My role here within Irwin is to assist clients with their investor targeting efforts, as well as their custom board reporting. And before I joined the Irwin team about 2 years ago, I spent about 4 years within investment banking, primarily focusing on mergers and acquisitions.
Perfect. Thank you so much. And last but not least, Cameron.
Thank you very much, Katharina. Yes, so Cameron Rennie, I'm one of the consultants here at Rivel. We are an IR advisory firm that supports companies across the world. I've been in the industry for over 10 years. In a past life, I actually supported fundraising for fund managers. So I have spanned two ends of the sausage factory, as it were, to keep it PG. And then on top of, I don't know if I can top being an aspiring chef. I think that's fantastic. Well done, Phil. But I am quite handy with a micro digger, believe it or not, one of the ground movers. Yeah, there's a little fun fact about me.
Thank you so much, all. Maybe just to add some fun fact about myself. So I'm in the webcasting team, but I like to upload my background the wrong way. So if we can read SparkLive and London Stock Exchange in the right direction, it means I have done a very good job today. But now let's do a bit of housekeeping before we begin. So this session will be recorded, and anybody who wants to watch it again or share it with any colleagues can do so by revisiting Spark Insights, where we will host this webinar as a video on demand going forward. And we also want this to be a very interactive session, so we do encourage you to ask questions using the functionality built into the platform. You will see the Ask a Question option on the right-hand side of the video player on your screen. You can submit your written question, and I will present them all during the Q&A section at the end. And thank you all for joining today. So now let's get started. Our first topic is defining effective investor targeting in 2025. Mark, if you could give your view, how should issuers approach targeting when their business fundamentals are changing? What strategies help maintain investors' confidence during transitions?
That's a very broad question, which ties into how you should approach targeting, but also always look to the future. But the basic question is, how long does it take for an investor to make an investment decision? And some hedge funds, they may buy one meeting, get the checkbook out, job done. But your general long-only investor is going to take between 6 months and 2 years to make that investment decision. They want to see, are you doing what you said you're going to do? So really think about, who are you today? So target for your today's investor, but also think about, who are you going to be tomorrow? So I like to view this as, when you look at peer group analysis, think about aspirational peers. So let's say you're a mid-cap company today, but you know that you've got a growth strategy, you're going to be a large cap company in 3 years' time. Who are those investors for tomorrow? Because your small mid-cap investors, you're not part of their mandate. They're going to be selling down those shares. So you need to generate that interest for the future. And the way you do that is start that engagement early. Think about targeting as casting a wide net. You want to reach out to a large, appropriate audience for today and for tomorrow. And then by doing that, you're getting people engaged in your story. So are you hitting your quarterly results? How are your communications with that investor? Are you talking about this change that you're going through? This could be about changing the size of the company, but it could also be you're a growth stock and your growth stock, you're going to be a value stock or you're going to be a yield stock. So who are those investors? You're going to have your generalist in the register, but ultimately you're going to be attracting a new audience. Don't wait till you're there. Think about this beforehand. Start that engagement really early. Use the tools available. Think about the peer analysis being the basis for all of your investor targeting. Who holds my peers, doesn't hold me, who's underweighting me. That's step one, but that's a very basic view of this. You really need to start looking at company fundamentals as well. Who's got a mandate to invest in you in the future? So really extending out your network and thinking about tomorrow's investor is exceptionally important.
Thank you. That was already a lot of insight. And obviously, IR teams don't have to do investor targeting on their own. So they also often work with their corporate brokers. Maybe a question for you, Phil. How can issuers best collaborate with brokers to ensure a balanced mix of investor targets from both sides?
It's a really good question. I think the answer is implied in the question. It does need to be a balance. Now, as I'm sure we all know, a big part of the investor relations space is about cultivating those long-term relationships. And this is no different on the broker side of the business. They want to put you in front of the best possible contacts to showcase their networks. And you, of course, want to be put in front of the best possible contacts to invest in your firm. What I will say is that most brokers and investment banks would be happy to include additional contacts as targets if you provide them ahead of time. So using your brokers as an extension of your network benefits both parties, right? Issuers can get access to investors that may have fallen off of the radar of brokers. For example, your non-reporting investors, such as your family offices. Well, brokers get valuable information that firms such as yourself would want to meet with contacts that they may not have had been prioritizing previously. So through this, both issuers and brokers are able to expand the Rolodexes of investors. And so I think if you have the data and reasoning behind additional contacts not provided by your brokers and bankers ahead of, for example, conferences or NDRs, there's really no harm in asking if they're able to make an introduction or set up a meeting, again, assuming you have that list of targets beforehand. At worst, they're going to say no, or they won't be able to connect you with your suggested contacts. And at best, you're going to be able to secure those interactions with investors that could one day become the cornerstone of your cap table. Either way, I encourage issuers to take charge of their investor targeting efforts and utilize their own research as a supplement to what brokers and bankers are putting forward.
Thank you. So really a mix of both inputs. And now we looked a bit at the perspective of the IR teams, but now if we switch it around and look at what do investors think, maybe question for Cameron, just from your perspective, what do investors prefer in terms of outreach? And are there formats or channels that stand out in 2025?
Yeah, it's an interesting question. It carries on from what Phil was touching on. The preference from the data that we have is for direct outreach. Investors invariably want to hear direct from the company that they think is going to be of interest to them. And interestingly, it's different from if you look at the North American market versus the European market, it's actually different, which we wouldn't normally see. I think quite a different spread. But if you look at a North American investor, they actually prefer direct outreach even more so than your European counterpart who may prefer or have more of an openness to a broker-led introduction. But I think it comes back to, what a portfolio manager likes to drive in terms of that communication with their clients. Always try and think about that flow through of the flow of capital. Everyone, your IR teams are reporting to the CFO in the same way a portfolio manager is reporting to a client. A family office has a principal that's staring at the portfolio and asking questions about certain holdings. And so in that whole process, everyone is trying to argue a case for why they've made the decision that they've made. And in terms of direct outreach, you don't often see portfolio managers coming out and saying, look, I got this great recommendation from my broker. Normally, they prefer to talk about things that they found either themselves or have come across themselves. And so by being direct, you can really tap into that. And then in terms of what works and what doesn't, look, I think you've got to think outside the box. There's any one portfolio manager, I think, covers maybe 100, maybe 150 stocks at best that they really know really well. And so trying to tackle everything in a one-size-fits-all approach just typically doesn't work. And you need to try and stand out from a very large crowd. And so what I like to try and think about is to think about the asset flow, as I say, and think about strategic asset allocation. Think about where those assets are flowing and how you can tap into those flows. rather than just being waiting at like Oliver turning up to the top of the table and asking for some more. Try and think outside the box and where there's some more supply of capital and see how you can best fit into that, and really think about how you can convey the message in a way that appeals to those investors, and really thinking, as Phil was saying, about being strategic over the interactions that you're having, and thinking, as Mark says, about what you look like tomorrow and also how you might fit into someone's portfolio.
Thank you. Maybe just a quick follow-up question on that. Now, thinking about different types of companies in terms of size and like how they're already known in the market, do you have any recommendation for a very small, not yet so well-known company compared to like a well-established FTSE 100 company? Maybe Cameron, if you want to follow up on that.
Yeah, I think, look, with any interaction, it's an education process first. And Mark's point about how long it takes for an investor to get comfortable, that is absolutely bang on. It takes a long time for a long-term investor to get comfortable with a stock. And, you know, that carries through into their allocation as well. They're looking for long-term investors. They want to make long-term decisions. And it's about showcasing the execution. So if you're outside of the top 100, top 250, if you're in that kind of space where you're illiquid, it's about really getting the message out there, speaking to investors, trying to get as many conversations going as possible, and taking a direct approach can really help. Because at the end of the day, you've got to think about the alignment. And in this business today, with the way that things are structured from a regulator perspective, it's not as fruitful as it used to be in terms of other people doing the work for you. And unfortunately, IR was already a busy task before, and now it's been made even more challenging by adding in a lot of investor targeting. So I'm sorry to say that I put that back and say, look, it's on the companies. We need to try and make sure that we have a compelling message and story to tell at all times. Even if you've got existing divestments that are going on, or the equity story is not 100% there, having that conversation early and starting it and engaging with the investment community is always the right step to take. You can continue that dialogue as things become clearer, but I think Mark highlighted this earlier on. You need to be having these conversations. So absolutely, if just because you're liquid, just because you're a smaller cap, doesn't mean that you're not appealing as an investment. It just means that your job is that little bit more complicated and challenging.
Okay, thank you. I've seen a lot of nodding, which obviously the people in the audience haven't seen, but I think there's a lot of agreement between the three panelists here. Yeah, you said, touch on it, maybe sometimes it can just be a bit more compelling to like reach out to companies. And then of course, if you look at industry trends, we speak about technology and how technology can transform IR. So now a few questions on that topic. Maybe Mark, if you want to go first, and also if you want to add anything to what Cameron has already said. So in terms of technology, what is the base data set for investor targeting, and what are its limitations in key investor markets?
Well, I think before I go into that, I just want to echo the comments of Phil and Cameron there around the use of a blend of the brokers and your own research and our direct outreach. Because one of the fundamental changes that we had was MiFID II, where brokers were having to charge commission to actually set up meetings between investors and their clients. So if you go to a broker to do a roadshow, you're looking at a subset of the global investor base and a subset of those clients that will pay the concierge fee. Now, some brokers will absorb that cost, some will pass it on to investors. When you then blend that with third-party providers, you've got a global data set of data. And third-party providers such as Equiniti and my friends on the call here today, by us arranging meetings or you doing direct meetings, means that there's no concierge fee. So we are unbiased in the market, looking at the global data set. Now, Phil's on here as part of the FactSet company. I think nearly every provider of data for a public holding does use the FactSet underlying data as their key primary data source. And this is exceptional in the UK. We're very lucky here with the Section 808 registers. The level of ownership information available, particularly on FTSE 100 and 250 companies, is unparalleled globally. When you look at US companies, again, part of that data source that feeds it, looking at 13F filings, it's good. There are issues with the 13F filings. There is window dressing that goes on in the US, a topic for another day. But that data is quarterly plus 45 days. And we're a little bit more reactive here in the UK because we're used to that monthly cadence of analysis and viewing of the data. But also, if let's say you're a UK company and you're trying to go and target into the US, we're talking about completely different levels of size of companies. A FTSE 100 company is a big company here. You're not really on the radar in the US. It's something I always like to talk about when we look at this. There was a big news story a few months ago. NVIDIA dropped 3%. That 3% that NVIDIA dropped in a day was about 70% of the market cap of the FTSE 100. So when you start to think about these levels and this magnitude, it's around understanding the data set. Who could buy me? What's underlying in those portfolios, and who's then an attractive proposition? Now, these data sets, they are very useful, but the timeliness of them doesn't give you that live analysis. If we're looking at a FTSE 100 company where the 808 register is being inspected on a monthly basis, a register of members on a monthly basis, by the time that's actually hitting the public data providers' terminals, so FactSet, Bloomberg being probably the primary two you'll be speaking to, your brokers definitely will be using Bloomberg data in most cases. That can be months old. And the way the data gets processed, dependent on the provider, sometimes there'll be old TR1 information being used. So, the threshold disclosures versus that real underlying fund disclosure information that you can receive from the 808 registers. But the way I like to look at this is you want to do an apples and apples comparison. So look at your public data versus the public data in your peers, and then you get that context. Because if you look at your private share register analysis data as a UK company, you've got granularity that is unparalleled, because there simply on a volume basis isn't the ability for these public data providers to give that granularity on the speed and for the cost efficiency it needs to be on a market-wide basis. So when you look across your peer group, it's older data and it's less complete. Just the nature of the beast for this. This is why people pay for share register analysis services. Ultimately, if you didn't do a share register analysis, there'd be no 808, there'd be no public data on your company. Again, story for another day. All of these things build up to be, how do you understand that data? But also, what's missing? Now, I think it's Donald Rumsfeld talks about the unknown unknowns. Who is out there, which, let's say, US investor with less than $150 million of assets under management. So think family offices, think these smaller, long-only hedge funds. Who's out there that you're not speaking to that could be a really good investor? Again, if I talk about the orders of magnitude between UK stocks and US, who are you going to attract? It's going to be these investors that are more nimble, aren't mandated for US-only securities, for example. Or how do you get in front of them? How do you become a US security? There are different mechanisms where you can be listed out in the US. So it's understanding what's out there, what do we know, versus what don't we know, who don't we know, who can put us in touch with them. And this is where providers in the market, we see who we're able to put in touch with. We talk to our clients, we see who people are talking to. And there's a huge number of these smaller investors that aren't disclosing their holdings. They aren't on 13F filings, yet they have such a large amount of capital and have really impactful investments into your company. Think about publicly listed companies versus privately listed companies. The privately listed company market is orders of magnitude bigger than the publicly listed, and more are becoming private. Think about in that kind of where the visible and the invisible investor world as well. There's some really great investors out there. Understanding how can you find them, who can you talk to, will open up a lot of opportunities.
Thank you. I think that was very comprehensive. And I think now we are very curious to look at the data and see some insights. So thank you for sharing that. You've also touched upon differences in North America and European market. I think Cameron also highlighted that before. Maybe question for you, Phil. So how can European issuers help North American investors get comfortable with different reporting standards? So there could be difference in IFRS versus GAAP, or the difference still today in semi-annual versus quarterly reporting.
Really timely question, given what the SEC and Paul Atkins have been saying in recent weeks around quarterly reporting. Before I jump into that, I just want to echo Mark's sentiment around these non-reporting investors, those sub 150 million AUMs, those smaller family offices. Issuers should absolutely not ignore those smaller investors. So again, Mark, great point there. Taking it back to the difference in reporting standards across the pond and the cadence, let me start off with the accounting question. Now, unfortunately, this is a really tough one for IR teams to get a handle of, given the differences in accounting standards runs very deep. And it would not be an easy project at all to be able to provide two sets of numbers on a regular cadence. However, What I have observed is that many of the headline numbers that investors and sell-side analysts focus on are not necessarily GAAP or IFRS standard metrics in the first place. Now, different industries do have their own preferences, but metrics like adjusted EBITDA, organic versus inorganic growth, annual subscription value, etc., these are by themselves non-IFRS financial measures, meaning companies have some semblance of control over how and if they communicate them. So I encourage issuers to take a look at comparable companies in their industries, regardless of geography, and see if there is a recurring metric, one key item that is reported that researchers seem to focus on. There's a good chance that non-standard metrics will satisfy most investor appetites without requiring your finance team to stress too much about additional workload. Now, the one caveat that I will add to this is if you do choose to focus on non-standard metrics within your reporting, always make sure that they can be easily bridged back to what you disclose in your audited financials. Professionals are usually open to using adjusted numbers like this, but it should always be clear to them how you go from your semi-annual audited figures to non-audited figures that are reported on a more frequent cadence. Now, while we're beholden to regulators on what the minimum cadence of reporting should be, the free market is ultimately what decides an appropriate maximum cadence. And unfortunately, in the information age that we live in, the more information is almost always better, at least from the investor perspective. Now, while it's not required by regulators, I have seen a growing number of European multinationals provide investor updates on a quarterly basis. Some of them call it, I believe, like a trading update, for example. These updates are usually shorter and contain less details than your interims or your annuals, but still provide information on where you stand on certain financial metrics or KPIs. I think that's probably the best balance that would satisfy investors globally. Save the extensive reports and supplemental disclosures for your main releases, but definitely provide an update on key areas like top line growth, margins, tracking against guidance on a quarterly basis, I would say at the minimum, to align with what the American investors are used to. I believe personally that the accountants who work on IFRS companies call them an independent review. So your company might have a different call for them, but long story short, quarterly trading updates where you provide top line figures and key metrics, I think that will satisfy most investors globally.
Thank you. And then when we speak about reporting, obviously we cannot skip the topic of ESG, which is like grown in interest and is like also involving in the North American investors. Specifically on ESG, how can issuers navigate the balance between ESG-focused stakeholder expectations and shifting reporting priorities? So maybe if you want to continue on that one.
Absolutely. And it's another really hard one because just like no company is the same, no cap table is the same either. And different investors will prioritize different themes. But what I can say with confidence is that interest in ESG topics is dying in North America, to put it bluntly, at least for the time being. I think it was about $33 billion USD has flown out of US ESG funds over the last 2 years. And we've seen mega managers like your BlackRocks and Vanguards of the world close ESG specific strategies, citing a lack of interest in capital. Now, this becomes a challenge due to regional regulators, such as the European Union, maintaining thematic reporting rules around sustainability. So while many of our clients have adopted to these enhanced disclosure rules and this double materiality mindset over the last decade or so, mega managers are quickly abandoning this as a prerequisite to access their pools of capital. And again, this is where knowing your cap table becomes exceptionally important. For example, pension funds in Europe are notorious for requiring significant ESG reporting from their portfolio companies. If your cornerstone investors come from these kinds of firms, you're going to be in a tight spot unless regulatory environments adopt a more laissez-faire approach. Now, on the other hand, if you're not targeting these kinds of pools of capital and instead are focusing on North American investors, you can focus less on these themes and highlight other areas of your business. Ultimately, though, I think it's important not to throw the proverbial baby out with the bathwater, so to speak. I'm sure we all appreciate that the pendulum swings and it can swing with quite some momentum. So while ESG reporting has become much less important outside of the certain EU boardrooms, there's always a chance that it comes back in style or EU-style regulations are adopted more broadly. So if your firm is one with a robust ESG reporting process, one doesn't require too much heavy lifting on the side of the IR suite, I see no downside in continuing to report as you always have. If you're at a firm, some ESG reporting responsibilities but a limited audience, you can likely take your foot off the gas and expect less of these questions from your average investor. But again, I certainly advise against dismantling the whole ESG reporting enterprise simply because of the current environment. So there is always a chance that it comes back sooner rather than later.
Thank you. So now we spoke about outreach, reporting, and just thinking if I've done all that, I think, Mark, you mentioned it takes like sometimes 6 years to get somebody onboarded as an investor. So let's take a look at measuring engagement success. Obviously, maybe I have a lot of meetings with investors. So how can we define if it was an successful meeting, if the outreach was effective? Maybe Cameron, we can start with you. So how many meetings should a company expect to have with a target before they initiate a position? And what does success look like and how can you measure it?
Yeah, the two great questions. Unfortunately, as much as I would love to give like a very specific answer, that it's so varied. It varies entirely with different subgroups of investors, is entirely depending on the company. And some of the points that we've made already, I think really highlight just how complicated and complex it is to really know how you're making progress. And I think that obviously there are lots of tools and mechanisms that you can use and leverage, and feedback is a great one. And there's a difference for clarity. There's a difference between feedback and perception. There are two very different things, but you can certainly use that as a good measuring or yardstick. And the other thing that we think is important is about time allocation. So when you're looking at your target list, how much time are you spending with your top targets? And as a result, are you seeing these communications progress and move forward? I don't think it's sensible to really grade everything based on how many people show up in the cap table, not least because I think you would probably get totally disincentivized before you manage to see any fruition. I think you have to be realistic. It's a long game. We do have some data that suggests that you would typically expect to see at least 2 to 3 meetings with an investor before they'd even likely make some sort of position. Now, I would say that data is possibly, if I'm being realistic, skewed towards maybe some of the larger, more liquid names rather than some of your more illiquid, more complex stories. And coming back to Phil's point on the challenges of being in that space and trying to attract those investors, is that fundamentally you have to have a compelling investment case, more so than the importance of your reporting schedules and your reporting styles and whether you're IFRS or US GAAP. It's much more that core level about the investment case. If it's a really compelling investment story, if it's a really compelling opportunity, an investor will go through an awful lot of hoops to get that through and into their portfolio if they can. The other thing I think is important to be careful of when you're targeting is to think about, is it even possible? And it's a great question to ask. We talk about what does success look like in a targeting program. Aside from everything else, being able to ask good questions at the end of your meetings is a really good way of getting that initial feedback, not from a, do you like my company perspective? Do you think we're good or credible or whatever? But actually just asking the question, do you see this fitting in your portfolio? And it's a question I used to ask allocators every time whenever I was working with a fund manager. And the reason for that is not to get an answer and a shake of the hand and a check at the end of the meeting, but it's to have that initial engagement of them actually sitting and thinking, can I even get this past my compliance officer? Can I get this quarterly dealing Japanese small cap fund into my portfolio and make it happen so that my family office can buy this? Is that even a likelihood? And you get an answer pretty quickly whether or not that's doable. Because at the end of the day, an investor really wants to get this off their docket. They want to get through this meeting so that they can decide, can I progress with this or not? And so if there's a real sticking point, then you know straight away what needs to change for them to be able to make that position. There's a compellingness of the investment story. You've always got to be trying to sell the story to them, but also asking big questions. And another great one to ask is thinking about, what were you concerned about taking this meeting today? Especially if you've reached out directly and you've engaged with someone, you've had a meeting, you've traveled to meet with them, you're having the discussion. At the end of the meeting, you say, well, or even at the start, what were your concerns coming into this meeting? And then again, you're going to pick up on those 2-3 things that maybe were top of their mind when they were taking the meeting. Maybe it's the macro uncertainty surrounding your business. Maybe it's the liquidity. Maybe it's the fact that you are in a sector that they're not comfortable with, coming back to the ESG piece. Maybe it's something that really drives their communications, in which case you can start ramping up the communication, the messaging on certain elements. So giving yourself an advantage going into a conversation and on the way out, really understanding whether this is even a comprehensible position for them to take. So I think there's less about there's no one size fits all in terms of how many meetings it's going to take. It's going to take patience. And what I think you need to be able to do more than anything is manage the expectation. Your own expectation as the IR team, but also the expectation of your board and of your management team. And that takes a little bit of interaction because not everyone has sat in that seat and engaged with the investment community over a period of time. Sometimes they're maybe new to C-suite positions. Maybe they've spent time in the private equity sector prior to being in publicly listed equities. And so all of these factors come into it when they're engaging with the investment community and expecting to get results like really quickly, or they're maybe used to a big push for a fundraise and then a quiet period afterwards where they consolidate and they deliver on some of the deliverables that they've been working on with the strategy. Whereas the public markets, it's like being on a merchant ship in the middle of a storm. You've got to communicate all the time. You've got instead of having a crew on the ship, you've got investors. And every day they're waking up and asking questions of you. So it's a very different world to be in for some of the management. And so managing their expectations over how long it might take, but also the demands of time that they're asking for can really give you a good position to be able to weather that storm of how long it might take for an investor to take a position. And then subsequently, a long-term investor, yes, they may take a long time to make that decision, but you also find that they're very slow to get out because they get the business, they understand how you're approaching things, and they take a very long-term time horizon when they invest, which I think everyone would love to have long-term, low turnover investors, but we can't all have that luxury all the time.
Thank you. Maybe Mark, do you want to add something to that? Like how IR teams can effectively target or like the best approaches that you would recommend?
Absolutely. It's building up everything that we've said so far on this webinar. It really is building blocks to get to the right investor targeting program. So lean on your brokers, step one. They've got those direct relationships, but again, referring back to the MiFID II comment, there's limitations to that. So really what you're hunting for when you're targeting is a mandate. And that mandate is, can this investor invest in me? So step one, peer analysis. You're a UK supermarket, peer group of the other supermarkets, who holds them, doesn't hold me, or who's underweight in me. Now think about this on a granular level, on a fund level would be my first step on this one. So you might say that, okay, we're slightly underweight from T. Rowe Price, for example, across the rest of the group. Why is that? Who are we engaging with at T. Rowe Price? Have a look at those funds that were invested. If you've only seen 3 out of the 15 funds that invest in UK supermarkets are invested in you, who's managing those other funds? Is your outreach complete? You should always target your current investors to maximize that investment. So your underweight investors and then new investors. Think about the effort and the reward. Your lowest effort outreach is with a current underweight investor. So are you maximizing that complete audience? Your highest effort is going to be the double absentee. Don't hold my peers and don't hold in my country. So why would they invest in you? But is there a mandate question for that? Do they hold globally in the supermarket sector? If I stick with this example, is there some form, rhyme or reason how they could invest in you? But then step 2 is think about your liquidity, which we'll come to that one later on, but your company fundamentals. Are you a yield stock when your peers are not necessarily yield stock? Who's a yield investor? What's your PE ratio? What's your relative PE ratio? Are there people outside of the normal network of investors? It drills down to the old, I don't want to call it the lazy way of targeting, but the outsourcing of targeting, if I put it that way, of allowing your brokers to run everything for you. Rate your brokers. Are your brokers taking you to the same investors in the same city every year? How many meetings have you had? What's been the return on those meetings? Are you using your time effectively? Understand, you look at these data sources. So who have you met? What funds do they manage? What stocks do they hold? Does this make sense? The data's available, with the caveats of the timeliness of, but land of the blind, the one-eyed man. You've got a little bit of information there. Use it, challenge what you're seeing. Use these data sources, as Phil mentioned, because you've got gaps in the schedule. If somebody isn't a fit, say, I don't want that meeting. These are the targets that I want to go and see. I will set those meetings up. And your brokers will be compliant. They might not be happy, but they'll be compliant with that because ultimately they want a happy client as well. And building your liquidity, building your outreach to investors is really key. But really see it as a step approach. In the base level, brokers, then your peer analysis, then go, right, fundamentals, who else is out there? Start with that broad net and then filter down who's a relevant target. Do they invest globally in your sector? Do they invest in your region? Do they invest in your country? Great. There's an opportunity there. And then the Rumsfeld list, the unknown unknowns. Those are those wild shots you can take, but it's worth reaching out. Keep knocking on people's doors and use every data source that you have. Those communications that you have with investors, with your advisors, and lean on companies such as ourselves. Say, who do you know is meeting people in the market? These are the critical things. But don't be afraid to cast that net wide. Get your story out there and then engage your efforts, IR only, and then ultimately getting the top level management going out to see those key targets. But keep things broad, all of those inbounds, use your advisors. Who is this? Who do they invest in? Have you seen any other interactions going on with this particular investor? Lean on everybody that you can. We're all here to help. And we've got, you look at one issuer as being a client of ours. We've got a broad set of issuers. We've got a breadth of knowledge of seeing what's going on in the market, and using that advice that we can give can really help to build on your investor targeting efforts.
Thank you. So you also talked about high level management time, and you said like happy clients, but obviously you want to have happy management as well. If you think about using time effectively, what is the benchmark for C-suite time allocation with the investment community? And how do companies balance leadership visibility with operational demands? Maybe Cameron, a question for you.
Sure. Quick point on, and this comes back to what you were just saying there, Mark. And it's not, I do agree with the kind of steps that you were showing there. I guess my view is a little bit, and I appreciate that the difference here is that I tried to, or was raising capital for weird things, right? Talking about Vietnamese small caps and African equities. So really odd and obscure and illiquid things in the past. And I used to apply that peer analysis. I used to look around, okay, who holds, maybe it's a competitive fund. I always found that it was helpful for identifying investors that may be already interested. But the issue I always came across, and I'm curious to get your thoughts on this, and Phil as well. I always found that the big question was they've already made their decision. And so I'm already going into that meeting trying to take someone else off a perch and put myself on the perch, or try to make the case of holding two. And even at a portfolio level, I used to know a lot of portfolio managers who would say, you know what, I've already got my exposure to gambling stock. I'm happy with Genting. It gives me my exposure. I don't need this as well. And I made that decision because of X, Y, and Z. Now, knowing what X, Y, and Z were was really helpful. But I always find, especially if it's a long-term investor, when they make a decision, it's a little bit like going into a bar and trying to chat up the married people. It just felt like it didn't work for me. I think that was more because I picked the wrong partners. That was maybe the challenge. But I think it's also symptomatic of the industry. We are quite bad for making our decision and sticking with it. If I'm a portfolio manager, I've invested in this company, then I'm invested in this company. And getting distracted by an alternative and doing all the work that's required to make it a new investment decision, I've made my decision, so I'm sticking with it. And so I feel for companies, especially if they've got like a limited number of peers, that ultimately gives you this list of people that are automatically going to reject you or going to say, yes, thanks, but no. Or equally, even worse, and I sympathize a lot with companies who feel like this, you're giving a free education, right? So you're then used as this kind of constant flow of information for a company, for an investor that's never going to buy you, but then helps frame their investment case for your peer. So I'm always nervous about that. And I think I love your point, and I think it's something we advise for clients very much, especially if you're targeting North American investors, looking at your fundamentals and thinking about peers on a fundamental basis. We call them cap peers. It's a really effective way of kind of thinking outside the box, right? So what makes me attractive as an investment? So to your point, Mark, one of the attractive fundamental elements to my company that I can then find in other businesses and then tap into a new set of investors, especially the generalists, because as we know, generalists are a lot more specific over who they want the exposure from one company. And it talks to this idea that companies or investors are typically looking for very siloed businesses. I don't want a business that's got 3 or 4 different business lines within it, because then I don't really know what exposure I'm getting. I'm getting 3 for 1, and I've only really wanted the one. So that element again helps if you're looking for the generalist investor. So I just wanted to make that point, and I'll come to your question. Sorry, Katharina, I've gone off piece completely. But yeah, I would, once I've answered my question, I would love to get both your views on that point. But in terms of benchmarks, to get back to topic, in terms of benchmarks for C-suite, we have some data, as you appreciate, Rivel's always got some data on it, but we've got some data on the time spent with C-suite on investor targeting or investor engagement. And typically that's slightly less with the CEO and slightly more with the CFO. Benchmarks being 10% of time allocated to the CEO level, 17% of time at the CFO level. And that works really well because they're looking for two meetings a year that with the investment community or an investor from the CEO to give the bigger picture, the larger picture strategy and encouragement, the cheerleading, as we like to call it. And then on the other side is the CFO delivering the how we're going to get there, the structure of it. So that makes an awful lot of sense. What's interesting is that for a small cap company, that the interaction actually gets higher. So we see a split across the market cap. So a smaller cap company, you should be expecting to see CEO, CFO engaging even more in that investor engagement piece. You've got to try and play to your strengths. And I think that one of the things that is to the advantage of some smaller cap companies is that you ultimately can have a much more honest and direct conversation. So if your CEO or your C-suite are good in front of cameras and good with investors, then play to that. Try to expand as much time and spend as much time as you can, but without overdoing it. So one of the tricks that we talk to is leveraging video media, for example. If you can create interaction points for the investment community on a consistent basis and have it residing either on social media, but equally on your website, that allows them to feel like they're getting that sort of interaction, that can reduce your time spent actually going and spending time with them. But over all of that, and it's really important to highlight this, the number one most persuasive form of engagement with a company is one-on-one meetings with management. So if you're lucky enough to have a C-suite that are willing to engage with the investment community and they're good with the investment community, then engaging with them is going to be helpful to you. So absolutely try and stack that up and back yourself on that one. But yeah, if you can at minimum meet the benchmark of 10%, 17%, then that's a good starting point. Beyond that, there's maybe a separate question entirely about what's overkill and how much is too much, because ultimately you've got a company to run, right? So you can't spend all your time speaking with investors. But hopefully that gives you a bit of a picture on it.
Yeah, I think that was summarized it quite well. And again, I saw a lot of nodding from Phil and Mark. So I think there's a lot of agreement among our panelists here. I think the topic we also touched on previously was the topic of liquidity. How can companies with low liquidity effectively target new investors who can help build liquidity? Mark, if you want to take that one.
Sure. Just to touch on Cameron's point, I agree. There are going to be investors who own one company in a sector. They know what they've done their internal beauty parade and decided going to invest in there. It's really a case of, does that investor understand you? And then you can write them off the list. That's the main thing. But absolutely, you're going to have those that only invest in one or two stocks in a sector. If you're the one, make sure they know your story. If they know your story and still don't want to invest, move on. Don't waste your time. There's an awful lot of investors out there to go after. But moving on to the liquidity story, I did a lot of work early in my career in Eastern Europe where liquidity is a massive issue. Frankly, liquidity is an issue towards the lower end of the FTSE 100 for a lot of issuers. And it's about understanding who can buy me with my level of liquidity and how much can they buy. Now, we used to call this the daily dollar. So what is the fiscal value of your average daily volume? Yeah, look over a 3 months period. So let's say you've got an average of $1 million of trading in your stock every day. I'm the investor. I like to invest $20 million into any investment that I make. How long is that going to take me to build that position? It's not going to be 20 days because I'm doubling the daily liquidity. Price is going to go up. It's going to cost me more money. So it's going to take me months to build up that position. Great. I've got a time horizon for how long I want to invest for. I've got a price target in mind and then I want to divest. It might take me a year to exit that position without impacting my liquidity. So really understand what level of comfort do investors have with my level of liquidity as an issuer. So we talk about aspirational peers, but think about liquidity peers. Use your data sources, use your advisors to say which companies have similar levels of liquidity and go cross-sector as well to build out a pool of investors who's comfortable with, for some people on the call, it might be $500,000 of trading average on every day. Who's comfortable investing in a company like that? What's their level of exposure? When do we think that they've reached their maximum position? And then you want to think about who should I target? If you're FTSE 100, look, you're looking for long only 5-10 year horizon investors. Brilliant. Nice, stable investors, top half of the register. Excellent. If you're an AIM-listed company, the more long only investors you have, the worse your liquidity is going to be. So you need to think about who's going to be filling that gap. Should we be targeting more hedge funds? Should we be looking for event-driven investors coming in? Really broaden your horizon and look at who's investing in these other companies of the same liquidity. That's a really critical thing. We always in these kind of events, don't be afraid to speak to the activist. Don't be afraid to speak to the hedge fund who might hold a 1 month position. That's ideal for you. You've got a churn. You can reduce the spread, increase the liquidity. Boom, you've gone up a tier of investors that's going to be able to invest into you. And you build on that momentum, tighten the spread, keep the daily dollar rising in your stock. And then you'll start to attract more and more investors. And the pool just gets larger and larger that you can go after.
Thank you. I think that also already started to address some of the questions we got from the audience who ask about market volatility, sector disruption, adjustment of targeting strategies. Cameron, maybe if you want to add something on that to the topic of liquidity.
Yeah, sure. I think it's like you have to engage with the investment community. It's an obligation, right? It's an obligation because when an investor comes and buys your shares, they're doing so on the basis that they can identify, or somebody will come along and buy it for more than they paid for it. That is the very simple basis that the markets work on. And if you're not engaging with the investment community at all, if you're not spending the time going and seeing potential investors, even being turned away, you're going to see more no's than you are yeses, hands down. And so you have to, it reminds me, it was when I was in Japan in 2015, 16, visiting companies with a Japanese equity manager, and he went into a tourism company. This was before the Rugby World Cup, before the Olympics. It was all kind of early days for tourism in Japan. And he went to this company, loved it. Management was great, really interesting, great growth fundamentals, fantastically cheap company. Comes out, the analyst says, yeah, but who else is going to buy that stock? And all of a sudden you say, yeah, because they're not engaging with investor community at all. They don't have an IR function. The only reason they found it was because it was on the back of a magazine in a local paper. And I'm not saying that the UK is like Japan. It is not. We've got a lot to our advantage. We have our language in terms of the reporting that we do and the engagement that we have is all very easy for us to engage with the investment community. It's all about finding that secondary buyer. And if you're not engaging with them, if you're not speaking to them, then it's an immediate turnoff for the investor, because they're thinking, I could buy a position. It could take me months, as Mark says. And then I get into that position and all of a sudden I need to wait for someone else to find you. And you're not going and finding anyone. So how are they going to come across your stock? Because there are 3,000 other companies they could buy. And equally to the earlier point about peers, there's probably 5 or 6 other peers that they could buy instead. So again, you're giving them the confidence that you're going out and finding new investors, showing them that you've got great marketing materials and that you're really actually making the effort, will give them confidence that you're actually in a turnaround position and you're going to go and try and find those new investors coming in. Might not happen, but at least you're making the effort. So there's an obligation piece for an illiquid business, I think. And look, it's the one thing you have control over. You can't control the markets. You can control your efforts within them.
Thank you. Maybe last question before we move to the audience Q&A. Sil, if you want to take that. So looking ahead, what trends or innovations do you see shaping the future of investor targeting over the next 2 to 3 years?
Yeah, absolutely. I think one of the things that we will see continue to develop in the near term will be the necessity for a faster information flow. So right now, it becomes exceptionally easy to pull up anything that you would like to know about a company via the use of, for example, a FactSet workstation, a Bloomberg terminal. In the span of 30 minutes, I can assemble years and years worth of knowledge on a company. And I think that flow of information is only going to accelerate, particularly as we start to see things like artificial intelligence being rolled out more commonly. Now, when it comes to how this impacts the IR suite specifically, I think that IROs are going to need to get used to providing more information to their investors. But at the same time, it is also a two-way street. I think that IROs will soon be able to leverage how much information is shared between the investment community as an opportunity to gather feedback on both their performance as well as the performance of their companies. It's something that I've noticed quite a bit when speaking to some of Irwin's clients. IROs are very interested in gathering feedback. What works about their story, what works about, for example, their last quarterly earnings call, what didn't, and how can we improve? So taking not only, again, the information sharing that I think is going to become much more important over the next short term, but using not only to the investor's advantage, but to your advantage as well. I personally see, again, this two-way street becoming much more busy over the near term.
Thank you. Now we move on to the written question Q&A. I've seen a lot of questions coming in, so I'll just pick a few ones randomly that sound very interesting. Maybe first one very quick. How much contact is too much? Mark, if you want to take that one.
Until people say stop, put yourself out there is my view. Use the right channels, target effectively is the main thing. Don't start harassing a supermarket sector investor if you're a bank. Make sure your audience is correct. Get them, send out your results. Don't wait for people to subscribe to your regulatory news feeds. Don't wait for that. Send out your results to a wide distribution list. Get in touch. Are you interested in having a meeting? Find out from your brokers any contact. If you're getting ghosted for quite a while, then is the juice worth the squeeze on this one? Leave them on your distribution list until they unsubscribe. We as a company, we send out thousands of people on distribution lists, people's results after they've gone out by the PIP services. The unsubscribe rate is fractions of a percent because people like relevant information being sent to them. Keep knocking on doors. It does help that I think a few of us on this call might be a little bit salesy as well, but it's the right thing to do. Keep knocking on doors until people say, please stop.
I think on that, Mark, I think it's also about sharing something that's helpful for them. So you think putting yourself in their shoes and trying to say, okay, what would be helpful? Taking interest in what they're doing. If we're not a luxury of it, but once you've got your target list, you should really invest your time in it and really get to know those targets, get to know those individuals that you're looking to speak to, and you're getting to, so that you can have a meaningful conversation with them. In the same way that most of my clients love it when an investor asks, the first question that they ask is, how's business going? A really long-term strategic conversation follows after that. And in the same vein, I think we are very bad at focusing more on how can I get out rather than what can I put in. And so I see it as more of a help me, help you situation with the investment community, sharing some insights, sharing some guidance, sharing some support, but also just being interested in them and what they're doing and seeing where that can lead. Especially trying to stand out in this market is really difficult. There are lots of people clamoring over a very small number of investors, and maybe taking that little bit more of a personal approach can be helpful.
Thank you. Maybe related to that, so you want to answer it. How do you differentiate between passive interest and active intent when evaluating investor engagement?
I think it all boils down to the topic of the conversation and the content of it. If you can tell that an investor deeply cares about your industry, your company, if they're really digging deep into questions that, you wouldn't expect to have to answer, I think that alone signals that an investor is deeply intentful with regards to your company. If they are just going around picking the tires, asking very basic questions. I remember I heard from a client that through several of their meetings, investors didn't even know what they were doing. I think that's a clear indication that, for example, organization would not be a good long-term fit for the IRO. So I think you can tell, like any real conversation between meaningful relationships, you can tell pretty early on in the discussion whether it's going to be a fruitful one or if it's candidly a waste of your time and the investor might just be doing some information gathering. But ultimately, at the end of the day, it is the function of the IR suite to entertain both those fruitful conversations and those, shall we say, less fruitful ones, because you never know what you can learn from somebody. Again, even if it turns out to be a bit of a dud of a lead, you might get some useful information on the industry or competitors, what the buy side is thinking. So ultimately, never turn down these conversations. Just be aware of where you should be prioritizing your time. And again, I think you should know very quickly after speaking to someone for the first time.
Thank you. Very last one for Mark, because you touched a lot on data before, which we're now all keen to see. Are there any surprising metrics or qualitative signals that indicate investor interest beyond meeting volume?
I'd say it's quite an interesting question, really. It's the quality of the meetings, really. Just touching on these points, what questions are you being asked? If you know somebody's invested in, as we touched on earlier, one of your peers, and they're probing, Is it because they're trying to get intel or because they're interested in investing in you? Turn the question around. What do you know about me? What questions do you have about our company? See if they've done any research. But the number of meetings is a metric. As I mentioned before around rate your broker, you might have had 10 meetings with the same investors in New York over the last 5 years. Have they done anything around it? Really question your activities. Time costs money. You don't want to take the chairman and the CEO on the road to the same investors, have crap meetings all the way through because nobody's engaged. You've got investors who don't know who you are. You want to really have high quality meetings. That's the most important thing.
That's that. So I think we're at the end of this session, but I just love this question very much. It's good to hear our audiences in asking interesting questions. So maybe just doing a quick round around the room, like very short statement from everyone. If you could give one piece of advice to IR teams preparing for 2026, what would it be? Maybe Cameron, Phil, Mark.
I'll give one line and it comes to what Phil was saying. It's a bit crude, but I think it's relevant here. You've got to kiss some frogs. You've got to go out. You've got to speak to some investors. Some meetings will go well. Other meetings will go badly. Investigate opportunities, investigate them, do your homework, invest time in investor targeting, and it will repay you. It will reward you. But certainly in 2026, go out and seek investment opportunities. Go out and tell a story. Convince people, have the engaged conversations. But most importantly, I think ask questions. Ask questions of the meetings, not just feedback. Feedback is, what is your hair? I don't like your hair. It's not perceptions and what are the strengths of the company? What do you see as being our biggest opportunity here? What concerns you about taking a meeting with me? Those are, gets to the meat of the question. And yeah, I'll leave it there.
I can jump in next year, and I think this is a bit more of a practical and very, I won't say technical, but yeah, let's say practical piece of advice is if you aren't already, then I would highly suggest getting organized. Everything that we've discussed today on the panel is very data heavy based on investor perception of your company. That becomes exceptionally difficult to leverage if you don't actually keep track of these things. So if you're not already, for example, taking detailed notes and logging them somewhere during your meetings, I highly suggest you get into the habit of doing that. If you aren't taking, for example, notes on investor profiles, so you understand what you were speaking about with them 6 months ago, a year ago, and how that relates to today, would highly recommend that starts again with 2026 coming up, new year. It's not a great opportunity to introduce new habits. And I think, again, staying organized so that your targeting efforts are just that much easier for both yourself and your management team. If you haven't already gotten a good system in place, doesn't hurt to start.
Just to really wrap it up nice and short, I'd say data only gets you so far. Your title is investor relations. Go out, talk to people, qualify the qualitative data that you've got, all these numbers coming through all these data sources. Go out, talk to people.
Okay, thank you so all. So 3 key takeaways for 2026 are ask questions, get organized, and go out and talk to people. I really love that. So thank you all for joining today's webinar. As mentioned, this will be available as video on demand. We will also share the written questions that we couldn't address with all the panelists. So if you've opted in to be contacted, they might reach out to you directly to answer your questions. For the audience who's watching live, please visit our website at the marketplace if you want to be in contact with some of the panelists or reach out to them via LinkedIn. I think they would love to hear from you some feedback or like even further questions. And then, yeah, thank you all for joining today's webinar and also like for the panelists for providing such excellent insights.